So let's talk about something that's, super important, but maybe not something you think about every day. We're going to unpack a law that might sound a little dry, but trust me, it's the invisible shield that's guarding the money you've worked so hard to save. We're diving into the general banking law of the Philippines.
I mean, really think about it. You put your paycheck in the bank and you just trust that it'll be there tomorrow. But what's actually making them protect your money? It's not just about a bank being nice or having a good reputation. It's the law.
And at the very core of this entire law, it all boils down to one single powerful idea. This is the bedrock, the absolute foundation of the trust we place in our banks.
Okay, see that phrase right there? The fiduciary nature of banking? I know, it sounds like a bunch of legal mumbo-jumbo, right? But this is everything. This is a promise baked right into the law. It means the relationship you have with your bank isn't just a business transaction. It's one built on profound trust and a massive amount of responsibility.
So what does fiduciary duty actually mean? Well, to put it simply, it means the bank is legally and ethically required to act in your best interest. They have to handle your money with the absolute highest standard of care, putting its safety way ahead of their own profits or anything else. This duty is the legal muscle behind the trust you give them.
Okay, so a promise is great and all, but who's checking? Who makes sure the banks are actually living up to this huge responsibility? Well, let's meet the watchdog.
And that watchdog is the Bangko Sentral ng Pilipinas, or the BSP, and they have some serious teeth. They are the ones writing the rule book for all the banks. Then they actually go in and conduct examinations to make sure everyone's following those rules. They're constantly monitoring day-to-day operations, and if someone steps out of line, bam, they step in and enforce corrective actions. They're not just making suggestions. They are the police of the banking world.
You can't just decide to open up a bank in your garage tomorrow. The law is incredibly strict about who even gets to be a bank in the first place. There's a very specific blueprint, and it's designed to protect all of us from day one.
And here are some of the biggest hurdles. Yeah, you've got to be a stock corporation. You need a ton of capital. But look at that last point, the fit and proper rule. This one is critical. This means the BSP literally investigates the people who want to run the bank, their integrity, their experience, their competence. The law makes sure that the people managing your money are proven to be trustworthy and know what they're doing.
Now, not all banks are built the same. The law draws a big line in the sand between commercial and universal banks. So a commercial bank does all the stuff we know and love, deposits, loans, that kind of thing. A universal bank can do all of that, plus it can get into investment banking, which is a bit more complex. Think of it this way. Universal banks can take on potentially riskier activities, which is exactly why the law separates them, to manage risk across the entire financial system.
Okay, let's get into the nitty-gritty. The law lays out some very specific rules of the game to keep banks from making crazy bets with our money. These are the guardrails that keep everyone on the straight and narrow.
I want you to just look at this number for a second. 20%. It might not look like much, but in the banking world, this single percentage is one of the most important safeguards that exists for your money.
This is the single borrower's limit, the SBL. It means a bank is legally forbidden from putting all its eggs in one basket. It can't lend more than 20% of its own capital to a single person or company. This forces them to diversify, and it prevents a bank from collapsing just because one huge client goes bankrupt. It's a simple rule, but it has massive consequences for keeping the system stable.
The law also has really strict rules for bank insiders, the directors, officers, and big stockholders. A regular loan to you or me goes through the standard process, but for an insider, whoa, it's a whole different ballgame. Their loan needs approval from most of the board of directors, and this is the key. The terms can't be any better than what's offered to the general public. This rule prevents executives from using our deposits to give themselves special, sweetheart deals.
But what about the worst-case scenario, right? What happens if, despite all these rules, a bank is about to collapse? Well, the law has a clear, orderly process for this too. This is the ultimate safety net. It's not chaos and panic. There's a step-by-step plan. First, the BSB detects a bank is in trouble. This triggers step 2, conservatorship. Think of this like putting the bank in the ICU. A specialist appointed by the BSP takes over to try and save it. But if it's just not salvageable, we move to the final step, receivership. The bank is closed in a controlled way, and an agency like the PDIC takes over to sell off the assets and pay back depositors. The key thing to remember is there's always a plan.
So let's just quickly recap the big points. The whole system is built on that foundation of trust, the fiduciary duty. You've got the BSP acting as the powerful watchdog to enforce that trust. There are strict rules on lending, like the SBL, to stop banks from taking wild risks with our money. And finally, even if the worst happens, there's a legal safety net in place to manage the failure and protect depositors.
And that brings us to the future. These principles of trust, oversight, and managing risk are timeless, but the world of banking is changing faster than ever. It's all moving online, right into our phones. So the final question we should all be thinking about is this. As banking becomes more digital, how do we make sure these fundamental laws evolve to keep our money just as safe in the virtual world as they do in the physical one?